Good afternoon. On behalf of Case Western Reserve University School of Law and the Center for Business Law and Regulation, I'd like to welcome you to this year's Dean Lindsey Cowen Business Law Lecture. The lecture was established in 2002, endowed with a generous gift from the Ferry Family Foundation in honor of Lindsey Cowen, who served as a professor and dean at the law school from 1972 to 1982, and those who were here when he was here have told me that he was both an excellent dean, but also laid the foundation for many of the wonderful things that have happened since. The Center for Business Law and Regulation, which sponsors this program, was founded in 2003. Its mission is to prepare future leaders to understand business issues facing entrepreneurs, business entities, and other clients, engage in legal, empirical, and interdisciplinary research on the role and impact of government in the regulation of business, and to foster public debate regarding the role of government in the regulation of businesses. And center programs range from public lectures such as this one, symposia, fellowships, conferences, academic workshops, and special course offerings. And through these programs, we aim to provide the core knowledge, theory, skills, and values necessary for successfully representing entrepreneurs in large commercial organizations in a constantly evolving, increasingly complex domestic international marketplace. And I've been honored to serve as director of the center for the last 2 years. Today, our guest to deliver the Cowen Business Law Lecture is the Honorable Frank Easterbrook. And I'd say it's truly an honor and a privilege to be able to introduce him to speak to us today. He is currently Chief Judge on the U.S. Court of Appeals for the Seventh Circuit. He joined that court in 1985. Prior to that, he had worked in the Solicitor General's office, first as Assistant to the Solicitor General and later as Deputy Solicitor General of the United States. He also was a professor at the University of Chicago, where he is still a professor. He is widely known as an expert on statutory interpretation, antitrust law, corporate law, continues to be a prolific writer. One line, Eric notes in his official bio that he has, among other things, written The Economic Structure of Corporate Law with Daniel Fishel, and a line that I couldn't help but repeat is that he has published numerous articles, several of them scholarly. But it really is an honor to host Judge Easterbrook here today to speak to us on whether or not there still is a race to the top in corporate law. I look forward to his remarks, and after the lecture, I hope all of you will join us upstairs in Blackacre for a reception with Judge Easterbrook. But you didn't come here to hear me, so without any further ado, Judge Frank Easterbrook.
Thank you. I'm delighted to be back in Cleveland. My last trip to this law school was almost 20 years ago. I delivered a lecture on presidential power to declare statutes unconstitutional. But my memories go back long before then. I grew up in Buffalo, which, despite calling itself the Queen City of the Great Lakes, lacks a Major League Baseball team. Now, the Queen City of the Great Lakes slogan, by the way, was invented by Millard Fillmore and comes from a time when Buffalo was the second largest city in the Great Lakes area, Chicago being the first, that is the king. It tells you something about what's happened to Buffalo in the intervening years, but it hasn't dropped the slogan. But keeping the slogan hasn't gotten it a Major League Baseball team. And Toronto didn't have a team when I was growing up either. So my father sometimes drove the family to Cleveland, where I once saw Herb Score shut out the New York Yankees. And I spent most of the summer of 1968 in Cleveland working for the Army Corps of Engineers to ensure that the shipping harbors in the channel, including the Cuyahoga River, were free of obstructions. There are two things I remember vividly about that summer. One was the fact that the Cuyahoga was topped with a sheen of linseed oil, which I could taste every day after work. In fact, I sometimes still can taste the linseed oil. And it was from a Sherwin-Williams paint plant up the river. And, of course, the next summer it would catch fire and make Cleveland famous for all the wrong reasons. And the other was that there was a garbage dump supporting a flock of gulls right at the end of the runway of Burke Lakefront Airport. So it was no great surprise when on July 28th of that year, a plane's engine stalled when it got too high a ratio of feathers to oxygen, and it quickly came back to Earth, and it plopped into the lake just off the runway's end. The Corps of Engineers sent a derrick barge to get the plane back on land, and the lawyers sent a complaint that came to the Supreme Court of the United States, which had to address the question whether the Death on the High Seas Act applied to a plane crash in Lake Erie, even though no one died and Lake Erie is not among high seas. It struck me then that I might want to become a lawyer. That was one of 2 times I have seen the events that led to a decision by the Supreme Court, and oddly, the other also was an inland admiralty case. But enough about water. What about corporate law? I chose the subject and title of this paper in homage to Ralph Winter's paper, published almost exactly 30 years ago, entitled State Law, Shareholder Protection, and the Theory of the Corporation. Winter's paper is the single most important contribution to the economic analysis of corporate law since Ronald Coase published The Nature of the Firm in 1937. Only the roughly contemporaneous paper by Jensen and Meckling about agency costs and the theory of the firm is a serious rival to Winter's. And to understand why I am today worried about a race for the bottom, I take you back to the 1970s when Ralph Winter was a professor of law at Yale. He was not to turn into a federal judge for another 4 years. The dominant academic view in the 1970s was that Delaware had waged and won a race for the bottom in corporate law by offering ever more favorable terms to corporate managers, who then moved their corporation's state of incorporation to that lax jurisdiction. William Carey wrote the most famous denunciation, but Stanley Kaplan, from whom I took corporate law when I was a student at the University of Chicago, held the same view. When the faculty of the University of Chicago teaches that markets are bad, as Kaplan did, and that only federal regulation can save the day, you know there was an academic consensus. Now, the argument runs that naturally managers want the most discretion under state law, the better to steal from investors. Naturally, states compete to offer that discretion to managers, the better to increase their franchise fees. Managers are concentrated and strong. Investors are scattered and weak, that bring to your mind visions of Burlean means. The separation of ownership and control, which allows firms to accumulate vast sums from thousands of people, left the investors powerless. Each is too small to have any influence, either directly or through corporate elections. Indeed, none of the scattered investors would study the firm with care, because each knows that he has too few shares, and thus too few votes, to influence the outcome of the election. And therefore, all investors are rationally ignorant and rationally passive. Thus, managers can do what they want. And what they want is to appropriate investors' wealth to the extent the law allows, and sometimes even beyond. So the professors and the political reformers clamored for stringent federal regulation to protect investors. Instead of letting managers decide how firms were run and governed, government itself should establish minimum standards for investors' protection. If states are unwilling, then the national government must do this. And this led to calls for national chartering, or at least national standards of governance, building on top of the national standards of disclosure from the Securities Acts of 1933 and 1934. If states were villains of the peace, as William Carey cast it, then the national government was to be the knight in shining armor. What Professor Winter, as he then was, asked is, how could everybody be so stupid? If managers can exploit scattered investors by locating in Delaware, everybody had to know it. Why would investors be patsies? Major investors are savvy, and over the long run, ignorant investors lose their money to smart investors. It's a good Darwinian approach. So at any given time, the people who control the largest sums of money and will have the largest influence on firms' organization and the price of their securities will be the most sophisticated investors, who know everything professors of law know and then some about corporate management and corporate performance. And if managers divert returns from investors, professional money managers and other big investors will put their money elsewhere, but they'll demand compensation ex ante. Because after all, in order to get investors to pony up, managers have to make credible promises that the investors are going to get some money back. If managers set up governance structures that allow them to skim, then investors will pay less at the outset until the lower investments raise the expected return to the competitive level. In this way, managers pay ex ante for the right to appropriate ex post. Investors put up less, and they're not exploited. If entrepreneurs want to raise more capital, they have to make promises that investors find satisfactory. And when we observe that investors funnel their money toward firms incorporated in states such as Delaware that allow managers large discretion, where board members don't have to serve staggered terms, where firms don't have to offer preemptive rights or cumulative voting, when we observe that investors put their money in those firms, they're telling us that the directory devices that managers want to get rid of cost more than the benefits they deliver. Corporate law came to be enabling rather than directory in the United States, in Winter's story, precisely because that serves investors' interests, not because it serves managers' interests. States that adopt inefficient regulation, as New Jersey did when Woodrow Wilson was governor, simply propel capital out of their jurisdiction. The history, by the way, is that New Jersey used to be then what Delaware is now, and Woodrow Wilson decided nevermore. New Jersey then adopted a strict program of investor protection, and all the capital fled to Delaware because it was offering what investors wanted. Well, what drives this engine, what drives Winter's engine, is ease of movement within the United States, has a large market, plus the internal affairs doctrine. It's a choice of law principle under which each state respects the rules that other states have established for corporations incorporated in each of those states. The internal affairs doctrine restricts states' ability to discriminate against corporations that move their place of incorporation to other states. So firms then could move their charters without moving their operations, quite unlike the real seat doctrine in Europe, which was created by France in the 19th century to block competition in corporate chartering from England. And it happened that Delaware was small enough to make a credible commitment to maintain an efficient law. It gathers about 25% of the state budget from corporate charter fees, and that's a bond of good faith between the state and investors who can't vote for the Delaware legislature. So they get the proxy of the amount of taxes that Delaware collects from them. Delaware, in its turn, enforces a strong fiduciary duty of loyalty, but allows firms to select freely from among institutions of governance. It's a sidelight, by the way, but the European Union now has rescinded the real seat doctrine as part of increasing organization, so a French corporation now could set up its corporate charter in England. But it will remain to be seen whether Europe will enforce the complement, that is, the choice of law doctrine, that what happens under the English corporation law will be respected in France. That remains to be determined. So we don't know yet where the EU is headed, but it may be headed in the direction of the American model. Now, competition among jurisdictions is insufficient by itself to drive a strong competitive engine. There are, after all, only 50 states. Most of the 50 states model their corporate code on a single model produced by the American Bar Association. And that's just not enough for effective competition to work along the lines of Charles Thibault's model of intergovernment competition. There are lots, and there are certainly more than 50, different models by which corporations will structure their own internal governance. So you can't get everything just by differences in law. But there are other sources of competition. One is financial markets, which I've already mentioned. Entrepreneurs have to compensate investors ex ante for inefficient rules. As long as at least one state offers a pure enabling model, that is, a model under which investors and managers and entrepreneurs can write contracts and the state will enforce it, then the market for financial capital will drive toward efficient corporate governance structures. Now, one may say, gee, once the firm raises all the money, it can exploit investors, right? Change the rules, exploit the investors now that all the money has been raised. But it turns out there are some fairly well-established things that prevent managers from doing that. Has it ever puzzled you, sometimes puzzles financial economists, that you see firms both raising new money and paying out old money all the time? Firms are in the market for new capital at the same time as they are paying dividends. They're paying interest on their bonds. They're paying down the principal on their bonds according to schedules. Firms have set themselves up in a way that, if you don't understand what's going on, is very puzzling. Why don't you just raise the money to begin with and then not raise any money later? It's costly to raise money. But the answer that's given you by the competitive model is that firms set themselves up, this kind of a bond between the managers and the investors. They set themselves up in a way that commits them to distribute some of their free cash flow. And by distributing some, that means they have to be in the capital market fairly frequently. And every time you're in the capital market, the value of corporate governance structures is being priced. So if you have inefficient corporate governance structures, that will be reflected in the cost of new capital fairly frequently. Michael Jensen and I made that observation in separate articles in the 1980s extending Judge Winter's work. Now, firms that pay more for money are at a disadvantage in a second competitive market, the market for their products. To make money in order to steal it from the investors, to have money to steal it from the investors, firms have to make money. And they can't do that if their rivals have lower costs of capital because they have more efficient governance structures. So oddly, in order to be in a position to appropriate from your investors, managers have to make credible promises not to appropriate from their investors, because otherwise capital will cost too much and they'll fail in product markets. Competition works wonders. Adam Smith would say something like, it's almost as if there were an invisible hand. And there are still more competitive markets that protect investors. Think of the market for corporate control. If one firm is poorly managed and its investors don't receive the highest return on their money, that depresses the price of its stock, makes it easier for some other firm to come in, buy up the stock, improve the management, and turn around and sell it at a profit. I've suggested sometimes that the University of Chicago should buy up Harvard, improve the faculty, and spin it off at a profit. But I keep getting told that that won't work because Harvard doesn't have tradable shares. So we can't buy it up through this mechanism. But the kinds of companies we're talking about here do have tradable shares, so that mechanism works. Now, Professor Winter wrote at a moment when it was becoming possible to test propositions about the way financial and corporate markets work. Data about stock prices was being compiled at Chicago by the Center for Research in Securities Prices. Computers were becoming cheaper. Statistical software was coming to market. Soon it was possible to conduct what was known as event studies. You look at how events in the life of corporations or corporate law affect securities prices. You filter out unrelated events, including general market movements. The capital asset pricing model provides a way to do that. And so you isolate the effect of the events you care about. And with savvy investors, changes in stock prices reflect real information. I'm not assuming here, Professor Winter certainly didn't, that stock markets are perfectly efficient. But at the margin, new bits of information will get priced by the market to reflect their relative contribution to the good and bad features of corporate life. And even when markets are inefficient, investors know that higher prices are better than lower ones. So shortly after Ralph Winter published his paper, it became possible to test the hypothesis that more discretion enables managers to design governance devices that are good for investors. And test after test vindicates the Winter hypothesis. When firms reincorporate in Delaware, the price of their stock rises. When they get rid of classified boards, the price of their stock rises. When they get rid of staggered terms of directors, the price of their stock rises. When states or firms do things that impede the market in corporate control, as by issuing poison pill stock, prices fall. The list goes on and on. There are debates about how strong these effects are, whether there might be some anomalies, but we know the general trend, and as Ralph Winter would put it, there is a race, it is for the top, and investors are winning. So we now come to the heart of my topic today, which is, are we still in a race for the top, or has the direction been reversed? When Winter wrote in 1977, the national government played very little role in corporate governance. The Securities Exchange Act of 1934 established some rules for voting in corporate elections, but they were all but irrelevant given the investors' rational ignorance and what was often described as the Wall Street rule, which is, if you didn't like how the corporation was being run, sell. It doesn't make much sense to study how the corporation is being run and vote, because there aren't enough other people who are going to do the same thing. And of course, there were federal disclosure rules, but the federal disclosure rules didn't have very much to do with the structure of management in the firms. And there were and are an increasing number of people who think they don't have very much to do with anything. Paul Mahoney, who teaches at Virginia, has shown that the benefits of disclosure, and there are some, had been achieved largely by contract before the 1933 Act came about. Given competition, the 1933 Act didn't add much, but neither did it do much harm. Since Judge Winter published his article, however, the national government has done considerably more. The Securities and Exchange Commission has added rules to the Williams Act, the 1968 statute addressing the subject of tender offers. And many of those rules, such as rules forbidding warehousing of stock, forbidding the secret formation of acquiring groups, forbidding short tenders, have gone far to hamper the market in corporate control. Congress has enacted tax rules that make many takeover strategies unprofitable and hinder some compensation devices used to align managers' interests with those of investors. And most recently, the Sarbanes-Oxley Act has specified many governance devices that all publicly traded firms must employ. Now, there's a big difference between these national rules and the state rules that we've been discussing, because the national rules are not default positions that investors can supersede by contract when they deem another device preferable. The national rules are prescriptions, and prescriptions knock out not only jurisdictional competition, but also several of the competitive devices in financial markets. If entrepreneurs and managers cannot, by law, are forbidden to offer different devices, then they're not penalized relative to their rivals for failure to offer them. If the mandatory rules turn out to be bad ones, investors can lose. The national government, in other words, can wage and win a race to the bottom in a way that states cannot. Winter said that Kerry was wrong to think that states are racing for the bottom. My addition today is that Kerry had things backward in thinking that the national government was superior to the states in corporate regulation. And we're moving toward national regulation of corporate governance. The Sarbanes-Oxley Act is lengthy, and if I describe more than a little of it, we would be here well past the time scheduled for the reception. So I hope you'll excuse my decision to condense. The Act does three principal kinds of things. First, it requires, and I'm quoting, equal and fair disclosure of corporate information. I won't get into detail, but the Act, together with the SEC's Regulation FD for fair disclosure, forbids preferential disclosures to particular investors or analysts. Now, the goal may have been to expedite disclosure, right? The story would be, if you can't make a preferential disclosure to your favorite analyst, then you'll disclose to everybody sooner. And stock prices will reflect the information, we'll all be better off. But the alternative, of course, is that if you can't make a preferential and secret disclosure to your preferred analyst, you may not disclose until later, if indeed you ever disclose at all. When you adopt a rule that says facts can't be revealed in confidence, you run into the fact that secrecy matters. Many of the things that federal law encourages firms to disclose are valuable not only to your investors, but also to your business rivals. And if benefits for investors depend on keeping something secret from business rivals in order to foster competition in product markets, then a rule that says no preferential access is equivalent to saying keep the stuff under your hat indefinitely. So it's far from clear that rules requiring equal access either will or even can help investors. The second principal requirement of Sarbanes-Oxley is that traded corporations have independent boards. That is, boards of directors, a majority of whose members are independent of the issuer and anyone affiliated with the issuer. Every firm has to have at least one committee to choose an auditor and another to set executive compensation, and those committees have to be completely independent of the insiders. The idea is that insiders forced to justify themselves to skeptical independence will be better servants of investors' interests. But is it a good idea? Well, the Sarbanes-Oxley Act sets up an adversarial model of governance more closely related to the judiciary than to cooperative production, and it may divert managers' time from making business decisions to making PowerPoint presentations. Perhaps CEOs will wind up, like cabinet officers, as frontmen who conduct roadshows, answer questions, and certify financial statements, while a deputy really runs the firm. Would that be an improvement or just a layer of bureaucracy? But I'm not worried about that model so much as I am worried about the idea of independent directors. Now, independent directors, the I in independent, often stands for ignorant, because independence is defined as not working full-time at the firm, not being associated with anybody affiliated with the firm, and so on. In other words, independent is defined as not being in a position to know what in the world is going on at this firm, except for what the real insiders tell you. In other words, you will be spoon-fed information by the insider. And of course, academics of all people should know this. Universities' boards of trustees are completely independent, but are also kept totally in the dark by the faculty and managers and deans and presidents and so on, so that they will be under the thumb of the people who actually work at the university full-time. Well, what's true of university boards is true of corporate boards, too. Roberta Romano has written a wonderful article called The Sarbanes-Oxley Act and the Making of Quack Corporate Governance. Her main point is that the Sarbanes-Oxley Act's governance prescriptions find little support in event studies of the kind I described a while back. And that's certainly true. If you look at what happened to firms when the Sarbanes-Oxley Act was adopted, the best estimate is that it probably cost about 5% of total value. But my concern is that even if event studies did show benefits, on average, from independent boards and an adversarial model of governance, there wouldn't be an adequate basis for suppressing competition in the design and implementation of governance devices. I want you to consider 4 models of the corporate board. One is the Sarbanes-Oxley model, in which outsiders choose and monitor the managers. Potential benefits are that outsiders have no particular interest in stealing from investors, but the drawbacks are that the lower stakes of the independent directors mean poor incentives and a poor supply of information, and that skeptical relations between managers and their board members may enmesh firms in bureaucratic tussles. That's model 1. Model 2 is a generational competition model. The board includes the top managers, and instead of a bunch of outsiders, it includes the underlings, the next generation of top managers, the people who will be the top dogs tomorrow. And in that model, generation number 2 monitors generation number 1 closely to ensure that the business flourishes until generation number 2 can take over. They've got good information, they've got good incentives, and investors are incidental beneficiaries. You can imagine generation number 1 and generation number 2 conspiring to steal from investors, but if so, generation number 2 would be left holding the bag, and as they don't want to be in that position, they'll be pretty good representatives of investors' interests. Model number 3 depends on large block holders doing the monitoring. The surprisingly large number of large corporations, even the biggest ones, have investors, or fairly small and cohesive groups of investors, that own 10% or more of the company's stock. Harold Dempsey showed that those large blocks are associated with better performance because people who have large stakes in corporations are pretty good monitors. Many firms lack such helpful monitors, and you can imagine that for them, independent boards may be better. But under Sarbanes-Oxley, independent boards and committees are required even for firms that have very large blocks. In other words, there may be really good monitoring devices that under Sarbanes-Oxley are being replaced by mediocre ones. Model number 4 is the market and corporate control. You assume in this model that boards are under the manager's thumbs, but outsiders are free to gather up stock and displace the incumbents. And they make a profit if, and only to the extent that, the firm is more valuable after the transformation than it was before. The takeover mechanism, in other words, judges by results rather than by process. Now, that market has pretty high transactions costs, which means that it can never be perfect. And alas, the national government has been increasing the transactions costs of that market. But a meta-analysis of empirical studies done by Lucian Bebchuk and others shows that what really helps corporations the most is changes that promote the market for corporate control. Rescinding poison pills helps investors. Removing staggered boards helps investors because outsiders can take control more quickly. Removing supermajority requirements helps investors. But the details of independence on the board help investors not at all. Which of those 4 models is best for a given firm is impossible to say a priori. It's easy enough for me to imagine that each of the 4 will work best for some percentage of the firms. Perhaps the independent monitoring model is best for most firms most of the time, but that doesn't justify the exclusion of other options. Vanilla ice cream is best for most people most of the time. It's by far and away the most popular flavor. But no one thinks that society would be better off if all other flavors were forbidden by federal law. Well, a reduction in the opportunity set makes everybody worse off, all of the time. And since there are no third-party effects in corporate governance, there's no excuse for curtailing the opportunity set. The third set of requirements in the Sarbanes-Oxley Act is more monitoring by accountants, in addition to monitoring by independent directors. And this takes several forms. The audit committee chooses the accountant. The accountant is forbidden to offer business consulting services in addition to accounting services. That combination is said to offer too great an incentive to go along with managers in order to get consulting profits. The accounting firm must turn over its engagement leader at least every 5 years, if not more frequently. Long tenure is said to lead to excess familiarity, so the costs of training replacements must be borne. I'm going to propose that the faculty at every American law school turn over at least every 5 years, but I suspect there might be some resistance from the audience. And finally, each firm must establish an elaborate system of internal financial controls supervised by the accountant. When Congress asked the SEC to estimate the costs of these changes, which were ultimately required by Section 404 of the Act, the SEC came up with a number of $91,000 per firm per year, which to Congress seemed like a small price to pay for better controls. The actual experience has been that compliance with this section costs approximately $7.8 million per firm per year, or about 30 times the SEC's estimate, which even for government work is not particularly close. The head of the new audit control body established by the statute says that this is much too much, and in any event, it has not so far caught, or so far as we can see, affected financial frauds. Frauds come to light when those in the know squeal, or when the results of the firm as a whole go south, or when somebody stumbles over them by accident. Now, of course, at this point, people often say that in light of Enron and WorldCom and other scandals, something just had to be done, and that Congress acted because Delaware failed to do so. Well, it's not clear to me that something had to be done. Like the poor, fraud will be with you always. And there have been lots of other frauds in American history that have not led to laws like this. The Sarbanes-Oxley Act did not cause the market to rise. As I said, on average, it seems to be about a 5% decline, and it's been stagnant since. Nor would it have made much sense for Delaware to have done something where the something in this blank is a reduction in the scope of competition and private choice. One of life's delicious ironies is that Enron was a model corporation by the standards of William Carey and the Sarbanes-Oxley Act. Enron had a majority independent board. It had independent audit committee. It had an independent compensation committee. Its auditor was Arthur Andersen, who was not only held out as the gold standard of the industry, but Arthur Andersen was the first to divest its consulting operation into a separate firm now known as Accenture. The post-Enron discovery that Andersen was bad, indeed a criminal firm, is a fairy tale. The Supreme Court reversed its criminal conviction, and Ted Eisenberg and John Macy found, after a painstaking empirical study, that Andersen had lower error rates than most of the other large accounting firms. Nonetheless, the upshot of the Sarbanes-Oxley Act is that today every firm must be governed just like Enron. That is what Congress enacted. It requires every firm to be governed just like Enron. One thing that went wrong at Enron is that the firm and its operations were so complex that people who spent less than full time there couldn't understand what was going on. And, of course, even some of the insiders have pleaded ignorance. One of the outsiders was Wendy Graham, an academic economist who at one time was chairman of the Commodities Futures Exchange Commission. Enron's audit committee was headed by a former dean of the Stanford Business School. If the head of the CFTC and the dean of the Stanford Business School can't make sense of a business like Enron as an outside independent director, what hope is there for a model of insisting on monitoring by independent and thus ignorant outsiders? And I remember, too, that the Compensation Committee of the New York Stock Exchange, also all independent, also all sophisticated, said after the details of Mr. Grasso's compensation package came to be known that they just didn't understand this complex stuff and never would have approved it had they had more information. Well, you're looking at the costs of independence. Now, you're entitled to ask me if independence and the other features of Sarbanes-Oxley are problematic, how this legislation came to be. And to get a handle on the answer, we have to think public choice, which is to say, the economics of politics. States can't harm investors for Ralph Winter's reasons. If states make bad law, capital migrates elsewhere. Managers can't harm investors through their choice of governance devices for largely the same reasons, although managers can harm investors by making Edsels, or indeed much of anything else Ford is making these days. But those aren't dealt with by governance devices, so I want to put that to one side. The managers in states don't have much power because capital is so mobile. Even when physical assets and labor are immobile, capital can move, the state of incorporation can move, the internal affairs doctrine coupled with the Constitution's Commerce Clause prevents states from discriminating against firms that move their governance elsewhere. But it's much harder to remove capital from the United States as a whole, and this country does not recognize the equivalence of an internal affairs doctrine when dealing with other countries. A firm that is incorporated in Japan and has its principal place of business there still has to comply with all U.S. laws when raising capital in the United States. We don't say, as the internal affairs doctrine would say, okay, you just have to assure people that you're complying by Japanese law, and now we can have competition between the Japanese system and the U.S. system of finance and governance. We say, the United States says, as an entity, only U.S. law goes. Well, that means that it is easier for things to go wrong because the mechanisms of competition are being undermined. And how do they go wrong? Well, think about the basic model of Mansur Olson in his wonderful book, The Logic of Collective Action, about how interest groups get what they want in politics. Any interest group wants to feather its own nest, wants to get more for its own members. But all interest groups that seek legislation are beset by free riding. Any one member of the group thinks, you know, if I don't contribute to this effort and sit on the sidelines, the results will be the same as if I contribute. So why should I do anything? I won't go lobby, I won't contribute, I sit. And of course, if everybody does that, why then the public interest may break out. But small and concentrated groups may succeed where large ones fail. Solve your free riding problem while other groups can't, and your political agenda flourishes. And this is what we see over and over and over. Groups from which it's really hard to drop out. Say, think of milk producers. You can't just stop being a milk producer and turn your farm into a law firm. It doesn't work that way, right? You've got capital tied up, physical capital, human capital. It's a group from which dropping out is fairly difficult, and which is also relatively small. And what you get out of that is milk price controls, in which Congress passes a law that requires babies to subsidize farmers, which is exactly what we have in the United States. We see this over and over. The power of the understanding that small groups are very successful in getting their political agenda enacted is borne out essentially every issue of the Journal of Law and Economics, which gives another example, or five, of some statute that bestows benefits on a well-organized and small interest at the expense of consumers. So, who are the interest groups in corporate law? Well, not the legal academy, surely. William Carey didn't accomplish much even when he was head of the SEC. Anyway, Ralph Winter largely converted the academy intellectually. So professors of corporate law are not an effective interest group. But the accounting profession is something else again. The accounting profession is highly concentrated. It used to be a Big 10, and then a Big 8, and then a Big 5, and then you get the idea. And it has learned that it can get benefits at the national level. The Sarbanes-Oxley Act roughly doubled the amount that corporations pay for accounting services. Now, does it surprise you that after multiple scandals show that accountants are not very good at detecting or preventing fraud, new legislation will require firms to double the amount of accounting services they produce? Why is there a law that requires firms to buy more of a low-quality good? But if you think in public choice terms, it shouldn't surprise you that accounting failures become a means by which resources are transferred from investors to accountants. Now, I hear you thinking, surely this is wrong, because investors lose when governance options are curtailed. Per Ralph Winter's mechanism, managers serve investors' interests. Thus, managers should be the first in line to defeat statutes such as the Sarbanes-Oxley Act, and since everybody knows that big corporations are effective lobbyists, this should protect investors fully. Unfortunately, what everybody knows about the power of corporate lobbying is hooey. Consider Mansur-Olson's question number 1. How does this group solve the problem of free riding? People who could influence legislators, if they tried, need a good reason to try, because exercising influence is expensive. If other persons similarly situated will do the job, any particular member of the group just sits on the sidelines, reaping the benefits without incurring the costs. And of course, if enough people sit on the sidelines, your group is totally ineffectual. As the group grows in size, free riding becomes first serious and then intractable. Is there a solution to be found? Well, overcoming free riding is easier when the group is small, cohesive, able to target large benefits on each member and exclude non-members from sharing in those benefits, and also able to spread the costs widely so that they don't stir up a lot of opposition. Your group prevails if its free riding problem is less serious than the problem afflicting its rivals. In many ways, the most powerful groups are those that the conventional wisdom treats as powerless. For example, minorities that have limited agendas and from which dropping out is not an option. So how do corporations fare at handling free riding? Poorly. Corporations don't vote. They're forbidden by law from making political contributions. So corporate influence depends on firms' ability to engage the interests of investors and other stakeholders, because it's their money that's really on the line. Yet there are very many large corporations with constant entry and exit. You know, the Ralph Naders of the world will point to the Fortune 500 and say, look, 500 giant firms. The Mansur-Olsons of the world will point and say, yeah, 500. 500, you can't solve your free riding problem. Right? The basic problem is not only that there are lots of corporations, but from investors' perspective, investors tend not to care about corporations. Large firms, the reason why this agency problem that we've been talking about can come about, the thing diagnosed by Burley and Means back in the 1930s, was that large firms become large and efficient by assembling lots of small investments of lots of small investors, none of which is substantial and all of which are quite liquid. What makes it possible to raise the money is the liquidity of securities markets so that people can get out as well as getting in. But that means that the firm can't solve a free riding problem. Investors can drop out costlessly. That's what liquid markets do. Portfolio theory has taught investors, and their surrogates at financial intermediaries, such as pension and mutual funds, that safety lies in diversification. A diversified investor cares about the success of the economy as a whole and is indifferent to the fortunes of any one corporation. Rational ignorance prevails. Most investments today are held in diversified portfolios, and they're held indirectly by insurance or pension trusts or university endowments, rather than by natural persons. So, to speak of corporations is to speak of the economy as a whole, and therefore to speak of a disorganized and ineffectual group, the target of small, concentrated, and therefore powerful adversaries. Businesses are at each other's throats. This is, of course, what competition in both product and political markets is about, and can't collaborate. Corporations that want to emit carbon dioxide must fight off corporations that manufacture carbon dioxide control equipment. 100 years ago, corporate holdings were more concentrated. The House of Morgan and the Rockefeller family could mobilize political power. The successors, the Vanguard Group of Mutual Funds and TIAA-CREF, are politically neutral. Only small, closely held corporations are likely to be politically effective because investors in those firms are not diversified, and dropout is costly. No surprise, then, that the small business lobby is very influential, that corporations with fewer than, say, 50 workers regularly win exemptions from laws imposing costs on larger business. Note, by the way, that the Sarbanes-Oxley Act does not apply to small corporations. So, if you doubt this perspective, just ask yourself, why is there a corporate income tax? It's not because corporations are wealthy, surely. Corporations are just placeholders, collective names for aggregates of investments. The corporate income tax is paid by the investors. But the corporate tax is attractive to politicians because it's invisible. No natural person signs a check, and investors are so scattered and diversified that they can't resist it. They can't even tell who pays it. As a matter of economic theory, the incidence of the corporate tax is very hard to pin down. Everyone believes that somebody else pays it, and so everyone supports it, although it is in many dimensions less attractive than a unified tax system in which only natural persons pay taxes. So, too, everybody believes that somebody else pays for reductions in emissions, safer products, and improvements in corporate governance. No concentrated interest group opposes the demand for regulation, which appears, to those demanding it, to have few costs. Worse, the innovations in the Sarbanes-Oxley Act turn out to be regressive and hamper competition in the product market. I mentioned that really small firms got themselves excluded from the Sarbanes-Oxley Act, but medium-sized firms did not get themselves excluded from the Sarbanes-Oxley Act. I also mentioned that the average cost of a corporation of compliance is about $7.8 million. But it's more interesting to ask what the cost of compliance is per dollar of sales. It turns out that for firms with very large sales, multi-billion-dollar corporations, the cost of Sarbanes-Oxley compliance is about 6 basis points on their sales. For firms that are covered by the Act but that have less than $100 million in sales every year, the cost of compliance is about 2% of sales. Now, of course, that tells you that the smaller firms are paying less, right? The $100 million firm is paying $2 million to its accountants, and bigger firms are paying more. But as a percentage of sales, the smaller the firm is and still covered by the Act, the greater the percentage it's paying out. So it has an anti-competitive effect in product markets as well. Well, what then is there to prevent a race for the bottom at the national level? Well, one answer lies in the special nature of this race. It's not being conducted by or for the benefit of corporate managers. The managers themselves remain in a competitive system, and if they choose any suboptimal governance structure, they'll pay the price in financial markets, which will hamper them in product markets. Firms whose managers choose poorly relative to other firms' choices will do poorly. So that's a comfort. But where is the competition going to come from, right? No competition among the states after Sarbanes-Oxley and these dimensions of corporate governance. It's knocked out the kinds of competitive engines that I suggested. So where does competition now come from? Well, one means of competing is to opt out of the Sarbanes-Oxley Act. The Sarbanes-Oxley Act applies to publicly traded corporations. You can become a not publicly traded corporation, what Larry Ribstein calls uncorporations. And all of you, I assume, have noticed that since the Sarbanes-Oxley Act, there has been an upswing in what tends to be called private equity or going private. Many formerly public corporations, the Tribune Corporation, for example, in my hometown of Chicago, have taken themselves off the market and gone private. And the Tribune ends up being run by Sam Zell, a very wealthy investor who I assume is a good monitor of his immediate subordinates. That system works only if there is some good way of gathering up capital in a way that competes with the great power of gathering anonymous contributions through stock markets. And in fact, we've seen great advances in the ability to do this. More and more private equity is being paid for by, university endowments, pension funds. Since we have large pools of private capital now, they can be moved in a way that will take some firms, quite a lot of firms, off the stock market. So some balance between public corporations and uncorporations still produces some competition. Another possibility is international competition. The United States may try to prevent it. As I say, the United States denies it is affecting its own version of the real seat doctrine. The United States may try to prevent competition, but the time when the U.S. ruled the global economy is past us. Increasingly, the United States looks to the global economy as a single state like Ohio or Illinois used to look to the United States economy. And that makes it more difficult to pass inefficient U.S. laws because capital will flee. We've seen this happen, by the way, in derivative securities. That is, options, futures contracts, one-off transactions such as swaps. At one time, the United States tried to regulate derivative securities, futures, in detail. New futures contracts had to be proposed to the Commodities Future Trading Commission, which would sit on it for years, waiting for academic studies almost as thorough as those needed to get a new drug to market. And the SEC tried very hard to prevent trading in derivative instruments that might compete with the instruments that were traded on the SEC's client exchanges, the stock markets and the option markets. All of that ended in the year 2000 with the Commodities Futures Modernization Act of 2000. And why did those rules all go away? Well, it would be nice to think that they vanished because professors of finance brought forward data showing that the newspaper-ish tales about derivatives, that they increase volatility, that program trading in derivatives caused the stock market crash of October '87, that they injure small investors and so on. It would be nice to think that these rules went away because scholars showed that the stories were all wrong. Well, scholars have shown that the stories were all wrong. Derivatives reduce volatility. They're great to trade. They're great to hedge against risk. They're great to trade because they have lower costs per share of stock in trading than actually trading the physicals. But it would be foolish to suppose that scholarly studies change national legislation. If that were so, Sarbanes-Oxley never would have been enacted. What happened to the regulation of derivatives is international competition. Trades moved from the Chicago Board of Trade, which had to wait for regulatory approval, to exchanges in London, Frankfurt, and Hong Kong that weren't saddled by those regulations. The loss of business led everybody in the United States, the exchanges, the people who were using derivatives, everybody got up in arms and went to Congress and said, liberate us from this legislation that was meant to protect us, but in fact is injuring us. And Congress finally obliged. Now, of course, the international competition remains, but now it will be closer to being on the merits. The tendency of interest groups to want national legislation to play the role of handicapper general. If you find something that somebody else can do well, prevent them from doing it. All right? That's Kurt Vonnegut's handicapper general at the level of legislation. That can't be got rid of, but with international competition, its power can be stilled. And one can hope that a similar process will promote efficient corporate governance. But as long as the U.S. rejects a system of international corporate movement so that Singapore or Poland can be tomorrow's Delaware, it will be a very slow transition. Perhaps it will be expedited if investors move beyond uncorporation to disintegrate the firm itself. I've suggested in other work that with derivatives we can move closer to Coase's idea behind his 1937 paper that firms themselves could be largely disestablished and have smaller units cooperating on particular products. Well, finally, how effective competition may be in undoing this may depend on, I say this ironically, on the success of yet another federal initiative. One federal statute that I haven't mentioned so far, the Securities Litigation Uniform Standards Act, or SLUSA, as professors of securities law tend to call it, is one that makes it harder for states to try to play the grab and run game. Much securities litigation has been an effort by particular jurisdictions or appeals to judges in particular jurisdictions along the lines of, oh, well, you know, most of the investors in this firm are from out of state. Let's see if we can transfer some of the money and we attorneys will pocket it as it goes by. SLUSA makes that a little harder. And we will have to see. The Supreme Court finally decided its first major case on that subject last year, the Tellabs case. We will have to see how well that's carried out. But you'd never reach the reception if I launched into that subject. So let me close where I began. Ralph Winter's great article of 1977 brought light to a dark corner of the law and set the stage for scholarship for the next generation. We have to carry on the worthy tradition he began by asking whether federal regulation creates the very problem that Professor Carey feared from the states. Thank you very much.
We have a small token of our appreciation. I assume it's one that doesn't get in the way of the ethics rules that bind federal judges. But
probably have to report it on a dozen forms.
Please join Judge Easterbrook and us upstairs for the reception in Blackacre, and join me once again in thanking Judge Easterbrook for his remarks.